Good evening and welcome to tonight's live webinar, member-only content, where we look at ASX investment opportunities in review for the 21st of December. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances, and realise that not all investments are appropriate for every individual. Investor Signals operates a broking account service which includes access to our model portfolios, which include the algorithm top 20, 50 and 100, as well as the US S&P 100, access to our ASX and US high conviction models, and an independent portfolio where we can work in partnership with you to execute specific ideas and operate derivatives to enhance portfolio returns, predominantly using covered calls. If you're interested in opening a broking account or just like to clarify further details, don't hesitate to give me a call on 1300 614 002. The technology that we're using tonight is the Investor Signals member area. You can subscribe to it for $1,320. If you need some help with navigating your way around or some advice on how to best use or access the features, again, don't hesitate to contact me in the office. The graph up on screen there is the Nasdaq, very extended. We'll have a look at the valuations and a closer look at what we want to be watching there. This is a graph that I've commented on over the last previous weeks, and this is really just a summary of where the market's forecasting US earnings. So average earnings for the S&P 500. We're about to see the December quarter earnings come through in the next couple of weeks, which will be a test as to see whether the Q4 numbers, and just if you're able to follow my mouse there, what the market's looking for is a re-acceleration for Q4 earnings to get up to around $40 of earnings per share, which is what's needed to then start to put us on a run rate of being able to deliver this $168 of earnings in 21. But where there's even further bullish forecasts is in 22 earnings accelerate effectively 40% from where we are today to 22 numbers, and that's the bit that we question as to whether that's just too much optimism baked into equity markets. The main driver of, or at least part of the underlying driver of that excessive earnings growth is the optimism around the technology area and future earnings. So this is a long-term graph of the Nasdaq, puts into context the bubble of 2000. Not all technology stocks are expensive, and you might just take a look at, say, Apple, that trades on 35 times earnings, 0.5% dividend yield, and may deliver around 4% earnings growth. So expensive by historical measures, but then the same argument could be mounted for something like Woolworths, which is trading on a much higher PE than obviously what it used to. But does it mean it's ready for a correction? Well, probably not. So if the bond market in the US remains stable, and we've seen the 10-year Treasury yields move a little bit higher in the US, but they've essentially stabilized below that 1% mark. So where does the risk really sit? It sits in these overpriced stocks where they're trading on a multiple of revenue rather than a multiple of profit, and growth companies that have ended up extending into 70, 80, 100 times earnings. At what point does that, is that susceptible to a correction? And that may be as early as January, as we start to see these earnings results come through in America, if they're just not living up to that level of optimism that's baked into equity markets. With that, let's have a quick look at the Nasdaq and a closer look at that specific line that I've got on the graph there. So the Nasdaq remains under sell conditions. We've got a negative pivot point lower there, but for the time being the index remains above the average, and even though we had a probe below in the last US session, it rallied back not quite to its highs, but we're still very careful and watching this closely for a faltering momentum within that Nasdaq, and I'll draw your attention to that should we start to see that occur on the I'll draw your attention to it on the blog should I start to see that to occur. S&P 500 index, similar situation, continues to make higher highs and higher lows, is under a negative pivot point. You could sort of take this line just as a precaution, shuffle it up under there, recognize that the index is above the average, and if we see it close below that, a reason for a little bit of caution. On the local market, we've put in the resistance there at around that 6,770 level, just highlighting that the market's teetering around that 10-day average. I've put a support line under the stochastic there, and we'll just continue to watch, but really the leading indicator is those US indices rather than the Australian ones. Tonight I was going to toggle through the top 100 stocks, so we go into watch list, select ASX 100, get the greatest percentage gains to the top, and we'll come over here to the right hand column, organise them in buys. As we toggle through these, we're going to get a certain way through the list, and then the stocks are going to switch from buy signals into sell signals. All the stocks that are under buy conditions you can be found in our model portfolios, so you can click on there, select the model portfolio, and have a look at the dates that they were added and the performance of them. The methodology of a stock going into the model is simply it's switching from sell conditions into buy conditions. So tonight we're going to cover all the ASX 100, and I'll share with you my thoughts on a blend of technical and fundamental factors driving these stocks. TPG would normally report their earnings in March and September. It looks to me that we're not going to see an earnings update from them, and it may be a factor of post the Vodafone acquisition, but it looks around that 10th of February on the reporting calendar that we'll start to see some earnings, which will be the first result, which will show the consolidated numbers after the Vodafone acquisition. But I still have the view that there's some upside there, and you want to be a buyer of TPG on a dip. Fortescue, we continue to own this. Obviously, if we look back at the algorithm, Signal did a good job there at $8. Another Signal there at 15 continues to push higher and trades above the 10-day average as iron ore price pushes up to a new record of $165. Amcor's a new Signal, so it switched from sell signals up here to the top down to a buy signal. So we've added this back into model portfolio, supported around $15. And whilst the upside may not be particularly strong there in Amcor, it is a defensive business. Haven't checked the yield, but it's trading at around 2.5%, maybe nearing 3% yield at the moment. Has the capacity for about 4 to 5% underlying earnings growth, still getting the benefit of those cost synergies from the Bemis acquisition. So happy adding Amcor into portfolios, even if we are taking a slightly more risk adverse position of portfolios at the moment. Coles Group, we continue to own this and sell covered calls over it, or simply hold it as long as it sort of stays above that price 1780 support line. A2 Milk, now this has clearly delivered another round of earnings downgrades. So we've now seen earnings fall 40%, almost about 37%, under the company's guidance. Yet the stock price is down roughly 50%. So you could argue that a lot of bad news is now priced into A2 Milk, but the company is is facing challenges with the disruptions, obviously, with their distribution channels into China. And we'll continue to monitor that. There's an old adage to say, buy a stock on the third earnings warning. Whether that turns out to be the case, we've certainly had two negative earnings warnings so far. Whether the stock starts to rally prior to that third, or whether there even is a third earnings warning. But that's a substantial correction in percentage terms, 50% correction in the stock price, and as I mentioned, 37% downgrade in earnings from the company. But we continue to stick with A2 Milk until we get more clarity there. Evolution Mining's part of this whole gold basket that we're bullish on. We think we're in the early stages of gold finding support and moving higher, and we've seen the underlying gold price now rally from around, I think, 1730, 1740 US an ounce back up to 1900 an ounce, and you're starting to see buying interest now reaccelerate in these gold stocks. So Evolution can be part of that basket. ResMed, higher low there. The algorithm signals done a good job of picking the low there around 27. We've added that back into models and it's moved higher. Saracen and Northern Star is two of our preferred ways of getting exposure to the gold trade at the moment. Next year we see those merge together, so you've got added cost synergies there that will help to boost the bottom line beyond a strong gold price. So buy Saracen, buy Northern Star. Cube Holdings, the growth is a little bit lower here, but I think on a 2 to 3 year outlook, Cube remains an attractive asset, and you want to buy that on the dip, and there's certainly space for that in a portfolio. Next, DC, still concerned about the way this company reports earnings, and it mainly has to do with the depreciation and amortization that gets the company to a profitable position. So we don't dispute that they're operating in the right space, providing cloud services, but some question mark over the way the profits reported. Putting the fundamentals aside, from a pure technical standpoint, the algorithm engine's done a great job of picking up the lower lows and the buying opportunities through here. So if you are trading, it's one you may want to be long, but just run stop losses sort of below those prior pivot points. And in this case, it'd be around $11. There was the last pivot point. Aristocrat Leisure, buy this on the dip, so we've added it into model portfolios. We haven't taken it as an overweight position. We still have some level of caution as to what, whilst their digital strategy and digital sales continue to accelerate, we do have some level of caution of what just outright demand for new machines, given obviously the COVID impact of casinos globally. We'll get a clearer idea of it as the next round of earnings results come through, but we have bought this off the recent algorithm signal there at around $28, and we've added it into portfolios again there at around $29, but not an overweight position. JB Hi-Fi, under algorithm buy signals from the lows there, not doing too much in that at the moment. Afterpay's obviously had a big rally from the last round of algorithm signals at 30, pushing 112, but again trading on sort of more than 30 times revenue. Gets hard to judge of what's fair valuation for Afterpay. Northern Star Resources, so we like this, buy this on the dip here at around this $12-13 mark, as with any of the gold stocks that we cover. QBE Insurance had an earnings downgrade. I haven't had a chance to read through it in detail, but there was a revaluation of a number of underlying assets, and I think write-downs to do with their US insurance business. We've seen some of that flow through to a slightly negative impact on QBE and IAG. On Suncorp and IAG, but we continue, for the time being, QBE remains under algorithm buy signals, so we'll continue to review the fundamentals on that. Sonic Healthcare fits into sort of our risk-adverse portfolio allocations at the moment, so we've been a buyer of this on dips, added it into portfolios off this $30 level, and been another buyer of it on this sort of recent pullback here, and I've been talking about that on the blog. For the moment, the stock's above the 30-day average, the stochastic's trending higher. It is expensive, so I wouldn't be looking for the short term for too much more above $35, so you could think of selling covered calls there to drive extra income. Car sales, we've been patiently waiting for this to switch to algorithm buy signals, pulled back from 33 back down to at around $18, $19. It was added back into the model portfolio, now pushing 20. If we have a closer look, even this shorter term technical pattern looks quite strong, where it's had a rally, a pullback, and closed on the session highs there today. High quality business, and probably still one of the preferred technology plays within the large cap area of the market. Wesfarmers we continue to like. Good long-term e-commerce strategy there that's just starting to really gain traction. So any pullback there, you want to look at that as an opportunity to add it into portfolios. Newcrest, again, evidence that we're starting to see buying building these gold names. Strong close today in Newcrest on the session highs above the 10-day average. Stop losses below 26, but hopefully they don't come into effect. We're in the early stages of seeing this gold trade begin to build momentum, and the catalyst has largely been the approval of the stimulus in the US that started to trigger the rally in gold. XTO, similar to the XJO, which we've already covered that in the indices earlier. The XTO is just a ASX 100. The ASX itself, we've seen this correct from 92 down to 74. It feels like we're getting down into levels where this could be starting to get a little bit oversold. I've been drawing your attention to this one on the blog. We're buying it at the moment. If you want to be patient, you could just wait for a cross above that 10-day average, but we're getting down to levels where on a yield basis this looks attractive, even if they deliver a soft earnings result. Domino's switched to algorithm buy signals here at around this $72, now 87. We hold that in our model portfolios and it's been a good performer. Ramsay Healthcare, buy this at $61. We don't see too much in the way of upside, so maybe a rally back to $65 you could think about selling covered calls. If we look at the performance of the stock for the most part of the last 6 months, it's really tracked sideways between that support of 61 and resistance at around $70 there. Altium, high quality technology company. We have seen some downgrades in some of these Australian technology companies. For the time being, Altium comfortable, to be a buyer of this on the dip. Just don't want to be too overexposed. It's not an overweight position in portfolio. Ansell, we like this value down here at around $32. Maybe in a real soft market we could see a correction back down to $30. Not expecting that. We've been buyers of it on this dip on above that support line there. Qantas, new switch to algorithm buy signals. Today, struggle to get my head around this from a fundamental standpoint, so I'll just leave this one on the watch list. We'll continue to review it closely and I'll update you on the blog based around sort of the fundamental drivers for that. Sydney Airports, we're bullish on this with a view that around $6.57 was full recovery. We've seen the price soften a little since then. Maybe just highlight that there's a price gap back there to around $6 and probably comfortable being a buyer of it on a dip back to $6. Computershare, we've liked this. It switched to algorithm buy signals here at around $12. It was added into the model portfolios and it's been a good performer. APA Group, been a bit disappointing. I was expecting this to maybe rally a little bit stronger coming into the dividend on the 30th of December, I think the dividend date is. Look, we understand that there's a cost overrun in their project that they're working on up in, I think up in Darwin, which was likely to impact the earnings over the next 6 months, but we would expect to see buying support and we continue to remain sort of comfortable holding that, with a view that obviously we'll continue to take a closer look at the earnings fundamentals. CSL, we've seen a correction here from around 325. You can see there I've put support at around that sort of 280 level. I'd be a buyer of CSL, especially if we got down into that lower range. I'll just add that segment line back in. So for those that are not familiar, you simply go into the list here, select segment, and then you can identify where you want to draw the line and drag it in a position there. So the lower bound of that in CSL's back to sort of that 270 to maybe 280 level as a buying point. It has switched to algorithm buy signals and therefore it's been added into our model portfolios. Lendlease is now added into the model portfolios, and I do like the longest term story here. Obviously tough trading conditions for the company short term, and we'll be taking a close look at those earnings numbers as they come through in February. Transurban, comfortable owning this and selling covered calls. We know the dividend's going to get cut from probably where we're getting up to around 56 cents of dividend per half. That number's going to be more like about 38 cents. But owning it here and selling covered calls, good way to deliver fairly defensive cash flow to portfolios. REA is a bit expensive. The last algorithm buy signal did a good job of flagging the entry point at 106, but as far as adding to it at the moment, looks a bit expensive and we're waiting for a more substantial pullback. Cleanaway, stop and have a think about this one. The sell-off here from 260 back down to 230, roughly a 50% retracement of that sort of this last rally. I'd expect it to start to find support. We'd be looking for this stochastic to begin to move a little bit higher there. AusNet Services under buy conditions. Appen Group downgraded earnings. I think The earnings fell from about 130 million down to 110. Probably getting a little bit close to sort of all that bad news being priced in, so we'll continue to monitor that one and update you on the blog once we see it break above that 10-day average. Beach, the whole oil sector at the moment, we've just started taking profit in that area at the moment. Stockland's interestingly shifted to buy conditions today. I've created a bit of a wider channel there rather than sort of aggressively jumping into it at this 413. Let's create a lower band there at 380. I'll be watching the stochastic. I'll be watching to see sort of how many days we trade below that 10-day average, and just start to take a closer look at sort of where those fundamentals sit and update you on the blog on that. Flight Centre, not there at the moment. Fisher Paykel, we like this, although recognise that it is expensive, but buying this on a dip and maybe a rally back towards that $33 level and selling covered calls or simply taking profit. Cochlear still below the 10-day average. It is under algorithm buy signals. Maybe we probe down into this 183 level there. So again, if you're being cautious, you could wait for it to move back above that 10-day average. We are seeing early signs of the stochastic moving higher. But maybe a buy zone there between that 190 and 180 level. That's been added into our model portfolios. So now we've switched into stocks that are under sell conditions. The health insurers have done well today after announcing upgrades or increases to the insurance premiums of around 3.5%. So you've seen both Medibank rally as well as NIB Holdings. But the trends coming into these results hadn't been that favourable, so we'll continue to be a little bit cautious there. Oz Minerals, strong copper, strong gold price, so Oz Minerals benefiting from that. Iluka, we've taken profit on that at the moment. Sol not doing there. Alumina, we've taken profit on that, staying exposed to BHP and Rio and Fortescue. Suncorp, cautious there, so we're not adding that. James Hardie, maybe back up against resistance, but obviously the building sector continues to remain strong. BHP, continue to hold that. Brambles, undersell signals, and we don't very often buy or hold stocks that are undersell signals, but comfortable with the fundamentals here. Brambles should deliver 4-5% earnings growth, so owning it and selling covered calls back above that $11 there. The regional banks still not doing anything there. Our preference has been that BNKS Global Banks ETF, although we've just halved our exposure to that in the last few days. Rio continue to hold that. Vicinity's not doing it there and just starting to cut our exposure to the property ETFs at the moment. Ryzen Holdings not doing it there, but it does have yield support. Boral, like James Hardie, beneficiary of strong building industry, but maybe getting a little bit expensive there. Aurora, our preference is Amcor over Aurora. So Australian New Zealand Bank or ANZ Bank, we think all the banks are up against resistance where they are at the moment. We're mindful in the US that we've seen JP Morgan, Bank of America and Goldman Sachs and others start to recommence their share buyback programs. So the US government's put guidelines in around as long as they're delivering a certain level of profitability, they're able to re-engage in share buybacks. That should be bullish for the US banking sector. Whether that's enough to drive the US market higher on its own, or whether there's deeper concerns around overall market valuations and the ongoing impact of increasing COVID activity globally that sort of weighs on the US market. But again, I'd be drawing your attention to those US indices and saying, well, just be patient and wait for them to trade below that 10-day average before getting too negative on either the indices or the banks, which would be the trigger for obviously the inverse ETFs, which I'll have a quick look at those at the end of tonight, which will be the BBUS, BBOS, SNAS, etc. So I'll have a quick look at those after I finish toggling through these. Orica mining industry remains strong. The sell-off that we've seen here from 1750 down to 1550, it is a counter trend trade, but you could start to keep an eye on this, maybe run a tight stop loss there and just see if you get a rally back above that moving average as a trade. Link administration under takeover. Bank of Queensland not doing there at the moment. Seek. Look, surprises me how strong this is. I haven't had a chance to do a lot of reading on what the resolution was around the claims, around the accounting irregularities with the Chinese entity, but that needs to be revisited. And again, I'll try to do some reading on that and update you on the blog. But within those technology names, car sales is the standout for us at the moment. BlueScope Steel, again, strong building industry being a supporter here, up at around $18. We assume it's near resistance, but not really enough evidence there of them rolling over at the moment. Oil Search not doing anything there. Telstra, again, rarely do we buy these stocks that are under sell conditions, but the correction in Telstra from $3.20 down to $3, the company's reaffirmed its dividend over the next 18 months. Maybe there's a little bit of selling starting to exhaust, and there could be the early stages of a trade here in Telstra, so comfortable buying that at $3. Just need to be mindful that we are in an overall downtrend, so actually picking sort of that reversal in structural trend there is difficult, but the catalyst that we're getting closer towards it, Telstra remains that separation of Infrastructure Co from Telstra Retail. Dexus not doing there at the moment, still a little bit cautious on some of these property names. Westpac under algorithm sell signal below the 10-day average. Preference is still that BNKS ETF. Ampol, this is likely just trades within a range. We're buyers of it down here at 22. We had a target of 30. It's traded there. So the midpoint's maybe back to 26. Maybe we don't get back down and retest this 22 level, but it is a good quality company here and has created a new higher high, and I'd expect to see maybe a shift to algorithm buy signals on a further sell-off down to around $26. CBA, we're now on the short side of this. It is expensive relative to the other banks, so we're long the BNKS Global Banks and short CBA, and that's just really the beginning of an early positioning of a hedge as we take a slightly more defensive slant towards portfolios at the moment. Magellan under resistance there at $65. Macquarie under resistance at $140. Coca-Cola, we haven't seen any evidence of a higher takeover bid there. NAB's rolled over, it's below the 10-day average under algorithm sell signals. Woolworths up against resistance, it is under sell signals, but I don't think there's too much downside risk here, so you could either just take profit or just sell covered calls and drive the extra cash flow out of that. South 32 not doing there, that was a breakout trade that we were watching, but we don't see anything sort of further there to drive that in the short term. Santos under sell signals, rolled over and it's below the 10-day average. ALS below the 10-day average and under sell signals. Nine Entertainment below the 10-day average under sell signals. Treasury Wines cautious there for obvious reasons that I'm sure you've read in the media. Incitec Pivot, this was one of those breakout trades or those counter trend trades we're looking for. The bounce is largely done. All the factors you read around the commodity helping to drive Incitec are strong. Demand for global fertilisers remains as strong as it's ever been, one of the best years. We haven't yet seen this shift to buy signal, so we've still got this structure, at least leading up to it. We can see the sell signal there. We had this consolidation. The reason why I was happy with this as a counter trend trade is the company had moved to strengthen their balance sheet and the institutions moved quickly to participate in that. Well, since then we've seen the stock move from sort of this 190 up to 250. It's now pulled back to 230. Sort of that prior high would be around 215 or thereabouts. So I'd be surprised if we see a dip much below that, and it might be one that you just make a note of there around that 215 and revisit it, as will I on the blog. Spark not doing there at the moment. Atlas not doing there. Challenger cautious up against resistance. Goodman Group, high quality company. We like this, growing 9-10% earnings, which is fabulous for a real estate investment trust. It is expensive. We've seen a little correction from 20 sort of back down to 17.70. It'd be nice to see another leg lower back down to around that $16, $16.50 level, where we would be aggressive and add that back into portfolios. Insurance Australia Group, most recent signal was a sell there at around 550, now pushing 485. This is again a high quality business that's under margin pressure at the moment, and maybe over the next 6 months this becomes, or even less than that, this becomes a candidate for a higher low or a basing pattern to be put in place. I'd be surprised if we're looking at sort of an ultimate ongoing deterioration in this business. The fact that Warren Buffett has backed Insurance Australia Group gives me some level of comfort that the company's going to sort of get through this rough patch. So it's one that you want to keep an eye on. At the moment, there's no doubt that it's hard to draw any positive conclusions. It's under sell signals. It's under negative pivot point there. The stock's below the 10-day average. The stochastic's moving lower. But let's just watch that for a reversal of any of those factors. Charter Hall not doing there at the moment. Mirvac not doing there. Tabcorp cautious there up against resistance. Crown and Star to me are still shorts in the market at the moment. Downer EDI, our preference remains CIMIC, and if you haven't had a look at CIMIC for a while, make a note of that. You've seen that correct, and it's probably getting back down to a buy on the dip level. Origin Energy, we like this name, a little bit cautious, again hard to draw much positive sort of reference here. Under algorithm sell signals, negative pivot point, trading below the 10-day average, maybe back down. Say there's a price gap down to say 430. Say if we got down to around that 430, 450 level, there could be a counter trend trade there. It is a good long-term business, Origin. So Scentre Group not doing there at the moment. Worley's been cautious on that, so I've seen that correct from 14 back to 11. GPT, little bit cautious there. There is sort of increasing commentary from some global fund managers about the value opportunity in some of these office REITs. But it's not an area that we're gravitating towards too much at the moment. Star Entertainment, I think the increase of COVID breakout in New South Wales and the social distancing measures impact to inbound tourism surely has to start to impact what would already have been a tough operating environment. So not sure that the short-term sentiment supports Star. Xero, we've been waiting for a more meaningful correction here and a return to algorithm buy conditions that would require sort of a more material sell-off, and we'll revisit that when that happens. Woodside Petroleum, we've taken profit on that. AMP, so under algorithm sell signals here, rolled over, heavy close today, and picture doesn't look too good. AGL had an earnings downgrade, I think from around about 600 million down to maybe a little over 10% earnings downgrade, so maybe around that 530 level for full year earnings, so a little over 10% earnings downgrade. We last had the algorithm sell signal there at $14. If we back up a little bit further, we had one there at $18. So we're not yet sort of in that reversal pattern there, but we'll continue to monitor it. Maybe a stock that in 21 we capture sort of that bottoming of that long-term sell pattern that's been in place there. WiseTech not doing there at the moment, and back to TPG. So just to have a look at these inverse ETFs, and just to finish tonight discussing a little bit of hedging considerations in portfolios. So the Bear ETF, if you're not familiar, is an inverse ETF. It goes up 1% if the XJO goes down 1%. I'll go through these ETFs and then we'll finish tonight with a look at the indices, just as a reminder as what your trigger points might be for thinking about adding or increasing your exposure to these inverse products. So the Bear's the inverse on the ASX. The double inverse sort of ETF, which meaning that if the market goes down by 1%, this goes up by 2%, which is hence the name Strong Bear Hedge Fund. Is another consideration. So in this case, think about your position sizing, because it's effectively giving you double the exposure. So that's BBOS. In the US, the equivalent is BBUS, which is across the S&P 500. Again, this is a strong bear, so meaning if the index goes down by 1%, this will go up by 2%. And then finally, one that you may not be that familiar with, it's a relatively new listing, which is the SNAS, which is the short NASDAQ. So let's look at that reference point again on the index to say, well, at what point would we be starting to increase our exposure here? And with that, we go into the NASDAQ index and simply say, well, look, as long as it's staying above this 10-day average, it's obviously still bullish momentum. If we were to see a close below that support line, if we were to see the stochastic rollover, that'll be the beginning or the first signs of some momentum faltering. But for the time being, we can clearly see any sell-off is quickly followed by buying demand. But not to forget that backdrop where we have stretched PE valuations, and we are getting closer to a level where that NASDAQ ultimately will have a correction, which is partly why we're positioning more. Well, not partly, it's why we're now taking profit in certain areas of the portfolio and rotating more into healthcare, adding gold exposure, being attracted to things like Amcor. So if you'd like to know more about our portfolio positioning and discuss the type of stocks that we're holding at the moment, please don't hesitate to give me a call on 1300 614 002. And there won't be a webinar next week with Christmas, but I'll continue to update the blog throughout the holidays. But wishing you and your family a Merry Christmas, and thank you for listening in, and look forward to speaking again soon.